Powell from Norton Rose Fulbright is going to be introducing the panelists and then leading us through this discussion today. So I'm going to turn it over to you.
Okay. Well, I don't know about, I may be able to do a halfway decent job introducing the panelists. I don't know, about 5 minutes. So we have a really good, diverse group. We have two what I call true entrepreneurs that have done financings, and that's Kemal Farid and Panos Adamopoulos. Close enough. So have actually done startup funding in their companies, and so it can give us the benefit of the entrepreneur. Youngro Lee has a background in legal matters, but also in current equity financing, private equity, venture capital, and specifically crowdfunding. So it can give us the benefit of the sources of capital issue. And then Mathew Verghese, close, has a broad consulting background, was at Anderson, leading your, I guess, United States private equity financing arm, and so can also bring the benefit of somebody who can advise companies, knows the sources and uses of and the needs of capital for companies at different stages, from I guess startup all the way to advanced, more advanced companies. So what I was going to start out and throw out a broader question, and so the topic, when I heard it, it kind of reminded me of the blind man and the elephant. There was a lot of different ways of looking at challenges for startups. $50 oils, are we talking about E&P companies? Probably not. Upstream technology, deep water technology, what particular sector of the market, and does $50 oil, is that good or bad for innovation? And so everybody in this room has probably been through at least one Houston, Texas oil bust. I've been through, had the misfortune to be through at least 2.5. I think 2 were bad, and there was maybe half of one at some point in 99 or 2000. But then there were a couple in the 80s, one of the severe, and then kind of like in Nepal, sort of an aftershock that came about 3 or 4 years later. And at the time, oil went from $35 a barrel, I think, and then it bottomed out at $6 a barrel in 1986. So it would be the equivalent of oil today going to $12, $14 a barrel. But it created huge innovation. And I'd like the first input from the panel, is it the lemons or is it the lemonade? Does $50 in oil create challenges for technology companies or create opportunities for technology companies? So going back to that example, some of the companies that came out of the first crash was Landmark Graphics, that when the large companies started cutting back, they started cutting back research pieces and jettisoning people. And the guy, I can't remember his name, the founder, came from the Exxon Research Lab and formed Landmark Graphics with no money and sort of an earth-shaking product. So I'm going to start out, come all down to your end. $50 oil, is it a challenge? Does it create a negative landscape or a positive landscape?
It is a double-edged sword for sure, because the one thing that small companies who are in the startup phase or even growth stage companies need is they need reliable cash flow from sales of their products and services. And when oil prices crash, that's the thing that dries up, is new sales. They go sideways, where they get canceled, and decision-making processes take much longer. So early stage companies get into a cash crunch. So that's the bad side of it. The plus side of it is that during the boom times, often companies are so busy that they're just doing what they need to do. So if you're already in there in a company, they're spending lots of money, the crash happens, your existing customers slow down their payments with you, but if you're doing something that's very new and innovative, it's going to open the door for you to get in there, spend some time with them, because they're going to be considering, both the producers and the service companies are going to be considering new things that you can do. So there's an opportunity. You just need to be very patient, because the decision-making process during a downturn is long.
Well, just a follow-up question. The service companies, the buyers, with budget, their own budget constraints, reluctant to even look at new technologies? I mean, what's going to change or move the needle for them to take in a company with a new technology, a startup, and expend the money looking at it, maybe buying it, as opposed to staying with the tried and true tools?
Any question? Okay. So there's definitely a cultural shift during a downturn where companies are looking for new ideas that create efficiencies. So you can get in the door sometimes more easily during a downturn with new ideas than when things are very busy. So there's both that plus and minus. On the minus side, cash flow and spending is a little, it slows way down, but on the plus side, people have more time to consider new things, and you can get in the door and have more meetings with people who might have been too busy to even bother with something new when they were just busy doing lots of drilling and lots of exploration.
Matthew?
Slightly different perspective. I think if you're asking from a service company point of view, lots of those,
the purchaser, the customer.
yeah, so from a oil service provider point of view, a lot of those folks are trying to figure out if they're going to exist. You are still a long way from seeing the rationalization of that entire space across multiple categories, pressure pumping, drillers, etc. So anything as an offering that falls into the bucket of discretionary right now is generally not going to make a list in this price environment. I guess as a caveat, oil is at 60, Brent's at 67.
Oh, that's right.
Big difference, 50. But that's the issue that you're going to confront today. The flip side to that is what had been an abundant set of cash flows, just given the liberal pricing environment that the service companies operated in for such a lengthy period of time, having gone away, is now forcing for those that will make it through the downturn a fair amount of effort to be efficient, and offerings that can cater to that underlying need are viable, not necessarily immediately, but you're going to see demand for that type of product and service going forward. I know at my last firm, we tended to scratch off relatively quickly anything in interesting new technology categories, because we honestly just didn't have time to consider it in the context of revenue declines quarter over quarter, year over year of the magnitude that you're seeing.
And Ro, what do you think?
Yeah, so just to clarify, so NextSeed, I am a startup entrepreneur. We literally launched the company last summer. So I'm at the very, very early stages of what these guys are talking about. And I think this is really particularly interesting, and that's the reason why I wanted to come here, is because the word crowdfunding, so we are a Texas crowdfunding portal. You guys might have heard in the news about this thing called crowdfunding and how it's changing. So we became the first debt crowdfunding portal approved in Texas. So what we do is we help small businesses crowdfund from the people around them. Ordinary investors, don't have to be rich, don't have to be accredited investor, for those of you guys who are familiar with that term, and can sort of help the business finance. And the reason why it's important, I think, is because everything that we're talking about here, like oil going down, a lot of it is basically finance, right? Banks or major investors don't have the capital to lend to specific or invest in specific businesses. So crowdfunding basically means anybody, right, whoever you are around the world, being able to raise money from a lot of people. But instead of focusing on one or two rich guys to give you a lot of money, you're focusing on a lot of different people giving you a little bit of money because the total sum is the same, right? So crowdfunding industry, just to give you context, this year is 2014, last year, there was $14 billion of crowdfunding nationwide, globally. This year, they're projecting $35 billion, right? In 10 years, they're projecting $100 billion of crowdfunding. And that's why so much movement is happening in this industry about what does this mean? And you talk about the opportunity, so I'm of the view that whenever there is an issue, a crisis, like the oil, I don't want to call it a crisis, but a situation coming on board, there's always opportunities. Think exactly back to, and this is related to my own startup, the global financial crisis in 2008. Right? I was literally working on, I was a lawyer for 7 years, I was literally working on Wall Street at the firm that was representing the Fed, that was bailing out Lehman, or not even Lehman, but the entire industry. And so everybody thought the world was going to go down. Well, and in some ways it has very fundamentally shifted, but what's happened is actually a lot of, if you look at it, especially the technology field in Silicon Valley and San Francisco, I mean, you see companies like Uber, Airbnb, a lot of different marketplaces, right? Like, what's driving that? I think it's the people's desire to basically take matters into their own hands. And if you think about the term crowd, you know, whatever you think that means, you heard the term crowdsourcing, that's literally just people finding ways to do things with each other without a middleman. And I think that's what's changing about this, and that's what I think is really exciting from the non-oil perspective about what could potentially happen, because there's new ways to get things done that previously you had to rely on the traditional banks, you had to rely on the traditional private equity firms and venture capital. But imagine, you know, you have an idea, right? And you don't need much, you need $100,000 to get started. Imagine being able to put it online and have 10,000 people give you $100 each, right? That's the power of crowdfunding, and that's what my company, as well as a lot of companies in Texas and US, are trying to sort of solve.
So the last year, have you seen, let's say, startups an increase? I mean, I guess it's a new platform, right? But I guess prices started declining a year ago. Is that? I mean, have you seen smaller technology companies adopting your platforms before they might have gone to a venture capital firm?
So the crowdfunding is so complicated. There's so many different ways. So we do debt crowdfunding. There are equity crowdfunding. I don't know if you guys heard like AngelList, you know, Seed Invest, Circle Love. These are crowdfunding companies that focus on specific sectors. So that's why you see, and again, I just didn't know the context of this, the audience, but what people previously thought of Series A is sort of angel or seed round now. What people thought of, you know, seed round is not family and friends. Like, you know, it's just everything has shifted. And so I do think that informational sort of asymmetry that previously existed basically has become a lot more efficient, because if you have a great company or a great business, you can access a wider and broader group of people that you couldn't do before. So specifically in Texas, just to be clear, the law passed in, sorry, I don't want to bore people with legal details, but the national crowdfunding laws where anybody can invest in any company is still pending because the SEC hasn't finalized rules. But what happened in Texas is November last year, they went ahead and passed intrastate Texas law. So now any Texas business can raise money from any Texas investors. So that's why we went to Silicon Valley or New York for that matter, because that's personally where my connections were. But we started in Texas because the advantage that Texas has is, you know, with or without oil, right? It's based on oil, but now it's the size of the people and the size of the economy that has already been built. So that's why we started in Texas, and I think there's a tremendous opportunity for Texas to perhaps diversify from oil and gas and really become a leader in crowdfunding, and that's what personally my company is trying to press in Houston specifically and in Texas generally.
Okay. What do you think? Your company, how's $50?
So I will agree with all the comments I heard. I tend to associate myself very much with Kemal, although he's so way more successful. However, I need to point that all the things said were from the perspective of a company that has already been funded and is struggling in a new environment. How do I sell and how do I sell more? And I will talk from the perspective of a company that is not funded, but that just went through the funding process. And I am the founder and CEO of a company called Seismos that recently closed a $4 million round inside a very tight oil and gas market. So how does such a company deal with this very difficult environment? How do you confront investors, and how do you really negotiate a very successful deal? And I think we should bring this topic. And when I saw the title of this presentation, this panel today, you know, how do you raise money in a $50 oil Houston oil market, something like this? The first natural question that came to me is, why do you necessarily need to raise money from Houston? Even if you're an oil and gas company, is really Houston the place where you should raise money? And of course, you know, most of you will say, yes, you get the network, you get these savvy investors. Are all these always good things? I mean, most likely you're going to come across an investor who has invested in a company that is really competing with you. So all you will be doing when talking with them is spreading competitive intelligence, right? So that's one way to see it. These guys are very vulnerable to any market fluctuations. Why? Because they're based in Houston and because they tend to invest in oil and gas. Do you really want to be associated with such a fund? And of course, needless to say that they're over-sophisticated. They really know what they're doing. But sometimes there's a correlation with big egos, you know, when companies have that much knowledge, which makes them very invasive in the daily life of a small startup. So in the case of Seismos, a company that I founded, a software company in oil and gas, I could have taken both spins. You know, I could have focused on the Houston market, but I could also have focused on a more traditional software market. And I took kind of a diversified approach. Because I didn't want to expose myself and the company in that intrinsic risk, we formed a deal with Silicon Valley investors. We brought that very strong software expertise, and we complemented that expertise with angel investments, selected angel investments, coming from Houston, that brought the oil and gas expertise. So I think the answer for companies that have not been funded and are facing such an environment is that they need to be way more agile, the way they organize and strategize their fundraising process. And of course, they also need, and big time, they need to adjust the business model to the requirements of today's market. Because as a customer of mine has said, the only deals that really make sense in today's markets are the deals that is the innovation that is focused on OpEx and on improving efficiencies. There's no more time and space for those over-sophisticated, overpriced products. It's all about OpEx, improving OpEx, and improving efficiency.
That leads into a good question, or a kind of a follow-up that Mathew might have some input on. So there's an article a few days ago, I can't remember, it's one of the analysts, that was basically how a lot of the shale oil and gas companies are on a path to bankruptcy, but no one really realized it. And it was, as a lawyer, I get sort of amused with accounting terms, and they had one from Dilbert in this great presentation that said EBITDA, it's earnings before interest and taxes. And A is, what's the A? Ammonia or something. So the EBITDAX, which they said was really the death knell of these companies, creating this artificial financing environment where they're literally losing money on basically every barrel they drill. And that was, I guess, south of hundreds. So in this environment, doesn't that make the $50 or $60 barrel proposition better for innovators? You're saying companies that improve efficiencies, where you're really looking at actual cash flow. Now it's going to drive these companies towards innovation, or not? I mean, what do you think?
So to reconcile several points in that particular piece, certainly the public markets rewarded liberal outspending of cash flow in the interest of facilitating production. That happened, and companies got the benefit of that through increased equity valuations, and therefore you saw increased leverage and ballooning balance sheets really driving that. The corresponding issue, however, is, to your point regarding the shale component, decline curves are enormous, vary substantially depending on the basin, but you have to reconcile that production growth combined with the magnitude of the decline curves means that ultimately, to get to some reconciliation, you have to keep finding technologies that improve really production and EUR in your wells. So thematically, today, broad category of investment that originally was context as reservoir characterization is tangibly manifesting itself as a theme into a convergence between geoscience and engineering. And we know this space quite well, given what they do. But you're starting to see, initially among what will be the big two oil service companies that remain, but a number of specialty oil service firms, a sizable amount of investment and a desire to source technologies by companies that aid in production, prediction, and optimization, all as part of the how do I frac and complete better to increase production. Ultimately, the reconciliation is going to swing back, and anyone here that's on the capital market side knows the pendulum swings back, and E&P companies will be rewarded for outspending cash flow at some point again, right? Absolutely, right? Cyclical sector, that will occur. But for right now, you know, the dual benefit that well-positioned E&P companies are realizing is a tremendous amount of innovation continuing to occur in major oil service companies, a surge for technologies that can improve optimization, production, and ultimately decline in service costs of the E&P companies, so that they live within cash flow. That's the theme of the day, and, you know, continue to get back to where they're still making money in this present. Kind of skirt around your question.
No, I mean, that's exactly what I was going for, because where I was looking at this is, Pano, Kemal probably have opinions on this, but you know, we had the first cycle of the B2B, B2C, Web 1.0 companies, 95, 99, and it turned out no one could make money. And they were chasing revenues, and they're dependent upon one large, and I don't want to bring up Uber, but they're crazy valuation also. But you know, one valuation after another that was higher, but you didn't know whether they were making money. And then you came into the Google era, with all the innovation that occurred with e-commerce. And I'm wondering whether, you know, instead of pouring now the companies, you know, you wonder whether they're going to get religion or not, but pouring $5 million down a hole in completion costs, frac sands and fluids and exotic chemicals, whether by IT solutions, they could take, like your former company and your company, take $10 million and spread it out over the entire field and improve outcomes. And you kind of said that, I mean, they got to migrate that, but what do you think of your solution for, here's more conventional reservoirs, but it's an IT solution for maximization?
Yeah, it is an IT solution for production optimization. Or in other words, as we say, it's an IT solution which enables smart oil field decision making, which eventually improves the economics of the field. So I completely agree 100% that the direction where things go today is on utilizing such smart tools to optimize production and improve the numbers. The only thing I would like to add is that there's also a shift in the mentality of the companies, because when price was 100 plus, there was some arrogance developed in customers. They always thought that they did everything right. I remember that my pitching language to those same customers over time and over months shifted drastically. When I was talking, you know, at those good times before, you know, they were very reluctant in really getting closer to you, getting to know what you offer, because they thought they did everything right. As soon as prices started declining, the opposite thing happened. They started calling us, and they were trying to find out what is it that you as a small company could do to help us improve our economics. I haven't been through all the oil busts that you've been, but many people in my company have been through, like my CEO has been 40 years, was with ExxonMobil. So what he always says to me is that it is at these down times that innovation really occurs. Because whatever it takes, like you said, those companies will invest money, and eventually they will find ways to improve their OPEX. And that's why there's no doubt that hydraulic fracturing will rebound and will come back strong again, because companies will do what they have to do to innovate.
Zara, what do you think? I mean, does that message resonate with, you know, the crowdfunding group of investors?
Yeah, I'm coming from obviously a different perspective. I mean, obviously oil and gas is huge in Texas, and in specifically Houston. And there's a couple points that Panos said I really agree with so much, so I want to expand it, because I think the topic is entrepreneurs, right? It doesn't have to be entrepreneurs in the oil and gas industry, right? So I think the fundamental point is in Houston, because of the oil and gas industry, there is such an amazingly enormous potential for innovation in everything or anything other than oil and gas as well. Right? That's why in New York, New York became the second sort of startup boom city, because a lot of people in finance, including a lot of my personal friends, do tech. And the reason they're doing that is because, one, like Panos said, cost of starting a business, or I don't know if this is what you're trying to get to, but cost of starting a technology company is so much cheaper today than it was even 5 years ago. I mean, literally, with $50,000, you can do so much as long as you know what you're doing. And every one of you guys or anybody else who you know, I'm sure, maybe your sons or daughters or their friends or maybe younger folks, for them to get into the oil industry, they're brilliant people. I meet so many people in Houston. I've been here since a year ago. They know so much about technology, internet, like mechanical skills. Think about what that can accomplish in Houston alone. Like, I'm sure all of us every single day go through something like, this is so annoying, whatever that was. I wish there was a solution to solve this. Because that mind process is happening in San Francisco, in New York, in Austin for that matter, because they're taking advantage of it, right? So the one thing that I do meet when I meet entrepreneurs or want to be entrepreneurs in Houston, and then they tell me, hey, how'd you get started? I just tell them, look, you just got to go for it, because it really doesn't take as much resources as you think it might to get something going. But once you do, in a place like Texas, the sky's the limit. And to be very frank, I mean, so I've been communicating with a lot of entrepreneurs in Houston since I got here. I can tell you there are a lot of young people moving into Houston and Austin because they want to start, because they see, oh my God, look at this 4th largest city. I heard it actually passed Chicago without becoming the 3rd largest. There is so much opportunities here and nobody's doing anything about it. So there is people just literally on the ground today trying to build Houston into a technology hub, because they know once they become a leader, whether you're on the entrepreneur side or the investor side or VC side, whatever it is, there's a lot of potential to be had beyond the oil and gas industry. So I think that's one thing that I just wanted to add to this panel was that there's a lot of things beside oil and gas that if you just look at the right spot and put your heart behind it, I mean, Houston, I think, is just tremendous potential.
That's a good point. I mean, the biotech, there's a convergence of IT, biotech.
I would actually gap healthcare into the same, because I mean, Houston's obviously a big oil and gas healthcare, so everybody looks at innovation in healthcare, oil and gas, which is great, but for that industry, look at how many people are coming here. Like the fact that there's so many people, by definition, means there's opportunities to solve different problems.
Kemal, you went through at least 2 oil kind of, there's a 2000, there was, I remember, a decline. There's a lot of financing in 99, 2000, maybe 2001, and of course, 2007, prices went from 140 to 35 or something crazy.
Yeah, lost $100 per barrel in pricing, yeah.
So in your company, I mean, how did you, in your financing opportunities and marketing and customers, what were those periods, or how did you overcome the adversity?
So Merit Systems was, during those times, we weren't raising capital, we were a growing software company. Well, let's see. We were raising debt, not equity. So we were growing very quickly, say through this whole 2008 crash. It's a good example. So leading up to that, we'd been growing 30 to 40% a year for a number of years, had a lot of debt. We were about to close our first equity round, and when the prices went from 140 to 40, all those term sheets got pulled, and it was a larger bust because it was a broad bust in the marketplace, and so we were faced all of a sudden with, we had a lot of debt. We didn't get the capital raise that we wanted, which was really based around restructuring our debt structure to get the debt off the books and to have continued growth capital. And then, of course, in a downturn, spending slows. And especially in traditional IT, an oil company can just say, hey, we're going to buy that software a year later, or we're not going to buy any new licenses. There's a lot, they can just defer IT spending. They can wait another year for buying new computers, all those things. IT is very easy to turn off. And they'll also point out that, like what Seismos does, you can call it IT because it's software, but it's not really IT, it's science. It's reservoir science applied through software. So that's, efficiencies come from reducing subsurface uncertainty. That's where the value is going to come in the next step of improvements in unconventional resource optimization is by reducing that uncertainty. But we had to lay off 15% of our staff. We had to get very lean, focus on positive cash flow. We knew that software licensing was going to decline, so we started shifting a lot of our software development teams to doing service work. So we went out and got a lot of service work because during the lean times, often oil companies will get rid of a lot of their staff, and then they need you to do more work for them because they have fewer people. And that's how we rode that out. And it was very interesting because that next year, after that downturn, ended up being our most profitable year ever because it forced us to get very disciplined about cost and about cash generation. So we got lean, we got smart on cash flow generation, we did whatever we could to generate income, and we ended up being very profitable.
Thanks.
So I have a question. So we point out that during the downturn, we're worrying about the innovations. The argument seems to be, the thesis is that innovation needs to occur because we're going to, so that companies can now exist in this new regime. Are we seeing a shift from, say, investment maybe to acquisition? I mean, are like bigger companies trying to acquire technology? Is there more acquisitions occurring of earlier stage tech to fit in as opposed to trying to do like either internal innovation or, in this case, I don't know if you guys did much innovation during like your sort of slowdown where you guys are restructuring, because it seems like during the downturns, we need innovation. It's hard to do that organically, internally, quickly. But it might be cheap to buy it because you guys can't raise capital or part of it raise capital. But if we don't get innovation, then we may, when things come back up, we're now sort of stuck because now we're lagging behind. So I don't know if there's a comment on any of that.
I mean, I'll make a comment there. Because we ended up having some opportunity to really look at what we were doing, we did a lot of reinvention of our product line, and we did innovate. So we innovated both in our business model and said, hey, we need to be leaner, we need to be doing a lot more different variety of things for our customers to make money wherever we can, but we also ended up looking at our products and saying, here's some areas of need that we had been ignoring before because we've just been growing and growing and growing, and now in a leaner time we innovated and we came out with a lot of new capabilities in our software through that time, that's for sure. We didn't do any acquisitions of technology that year. In fact, we did a little bit of divestment of things that weren't making as much.
Just add to that, coming from a more tech background, I think acquisitions will be more prevalent in the future because that's exactly what happened since 5-10 years ago. Right now, back to my point, because it's so cheap to start a company, I mean, that was really the barrier to starting a company or starting something new as a smaller team 10 years ago. It's expensive. But now, if you're doing tech, and then this applies even for oil and gas industry, if you know something very specific that you know is equal value, for you to sort of implement that as a smaller team by yourselves, if you actually look into it, it can be very cheap. And for talking about getting the investor piece, no matter what the environment is, if there's a good idea and good traction, there will be money, right? And big companies, big organizations simply cannot compete with smaller teams. That's why Facebook just buys Instagram for $1 billion instead of trying to build their own, right? That's why they just buy WhatsApp for $19 billion instead of buying their own all those teams started with thousands of dollars. So even in the oil and gas industry or any industry, I think if you look at hard enough, if you build a team, there can be tremendous innovation. And in that case, the big companies will not, it's cheaper for big companies to just buy a startup, giving them a clearly more price than their valuation than to start their own team to do the exact same thing. That's just fundamental business right now. That's why Google's buying up everything, Amazon's buying up everything. That's why a lot of startups go with the business in mind. And actually, if you start talking to Series A, more VCs investors, they ask you what's your exit strategy, and they expect you to be like, I want to be bought out by these 3 companies. I don't know enough about the oil and gas industry, but I can imagine there are very sort of finite or very specific technologies or tools that if you had developed independently, that could be very valuable to a lot of different companies.
So I'll just make a quick comment on, yes, so the big Schlumberger, Halliburton, and then there's a number of tier 2 service companies. That's what they do. They don't invent anything internally. They buy startups that have the right technologies, and that's in good times and in bad.
Matthew, what do you think? I mean, this kind of environment, do the big ones jettison? Do they act foolishly and cut their,
Depends on the category. I mean, there's obviously a fair amount of divestiture that's pending, given some transactions. The Baker-Halliburton merger is about to spawn, has already announced a set of divestitures for a myriad of different reasons. But there have been a number of transactions that have continued to occur. In the content space with respect to pure data, the recent transaction with Wood Mackenzie is really a content play by a big data analytics player that's trying to replicate a platform comparable to what IHS has. IHS is a serial acquirer of a whole series of content offerings, and energy is about half of their portfolio.
it always reminds me of Computer Associates. How many different bolt-ons?
Right. Tucked away in an 8K not that long ago by Halliburton is an interesting acquisition of a company based in the UK that added a substantial amount of geoscience content into the Landmark platform. So you see transaction activity depending on the type. It's very specific. The flip side to it is in the prominent early stage energy tech funds, the exits of many of those transactions are going to be stretched out because valuations have changed, period. And so, that body of potential M&A activity, either by other private equity firms or through IPOs that were planned as the monetization pathway, those are getting deferred. But strategic buyers, for interesting niche technologies, or pretty soon to be rationalization of capacity, that will continue.
You've raised, you said $5 million?
We raised $4 million, but it was a hard stop. I mean, it could keep going, and I think one of the fundamentals is that the companies need to have the wow factor. And if you're doing something great and you present it the right way, you can get money. But your original question was, whether acquisitions go up or down during a crisis, and I don't really know the numbers, the historical figures to give you a reply on this one. But I can tell you the new startups perspective, and we think it's a tremendous opportunity because for the reasons that Kemal described, we are very lean, we're very cost sensitive, so we're educating an ecosystem that is very, very sensitive on expenses. We go lean by definition. But the good thing is that when the market starts going up, and that may be 2, 3, 4, 5 years, that's really the time that a new startup is looking for an exit. So we think that in terms of timing, that's really perfect for a new startup coming into the market.
Okay.
I'll give you a personal experience just on timing. I joined a relatively young seismic data acquisition company at the beginning of 2009. So the market had fallen off a cliff. It is a cyclical sector. I mean, we were 5 years old, but 5 months after we got there, we started writing a registration to take it public. And we took it public, 9 months after that. So the cycle is, where we are in this place in the cycle is literally just that. We're at this place in the cycle, and you're already starting to see oil service valuations having followed commodity price and rebounded substantially. Oil is at 60, it's not at 40. Not saying it won't go to 40, don't know, don't have that crystal ball. But it's a cyclical sector, and you're going to start to see rationalizations and valuations that are going to still be the basis for wealth creation, which is really the foundational piece, driver for entrepreneurship, for tools that enable sourcing capital. All of those core elements remain. You still got to have a good idea. You still got to prove a pathway to generating cash flow and being of value. Those fundamental things remain unchanged.
So Youngro, in your financings for tech companies, because they're really, you're kind of leapfrogging maybe traditional, I assume, venture capital rounds, or the strategy, what's the strategy generally if you do the crowdfunding and raise for a new tech company? $500,000.
So my company don't do startup financing. We do strictly small business lending, because that's a whole different issue. I can talk about for hours, but So I'll talk about startup technology part. I think it is a bit of, you got to be careful because the part about crowdfunding that really excites people is the fact that you can raise money from anybody. Again, so previously, until now, you can only raise money from accredited investors, basically people with $1 million net worth or over $200,000 annual income for 3 years. So now, when this national law passes, and now in Texas, you can literally earn money from, or get money from somebody making $50,000 a year. So you can see how that can be good, but also very bad, right? For grandmas to get ripped off by some, smooth, talking salesman. So for us right now, actually, we don't think that's the right model because at the end of the day, if people aren't making money on your investments, they're not going to invest. But if you're good enough to get to that stage, there are national platforms like AngelList, for example. Definitely check that out for all of you startup guys. There's crowdfunder. Just literally, if you just Google crowdfunding, there's so many different sites you can look at depending on what industry you're in, what type of capital you're looking at. So I would say it depends on what your stage you're at, but if you're at very early stage, and there's even crowdfunding platforms to help very, very early stages, raising $10,000 just to get basic legal documents in place, because as lawyers in this room know, that's also very important. And then maybe you get a little bigger, you just need $1 million, $2 million. And previously, if you're in Houston, all you knew is like the 5 rich uncles that you knew, and like you're begging them for money. Now, if you have a good enough idea, you can apply to these crowdfunding platforms. And if somebody resonates, and to Carlos's point about, and because I actually experienced it on my own fundraising, a lot of Texas investors I speak to, they're asking me, what's the cash flow? Like, where are your assets? Like, I do oil and gas investments, I do warehouse investments. And sometimes it's like talking to a brick wall. And then I go to San Francisco or New York, and they're like, I want in, because they get it, right? So that's what crowdfunding can potentially help you do. So if you have an idea, depending on the stage, literally, I can tell you, and I'll give my contact to anyone, like, feel free to ask me any specific questions you have, but I can guarantee you there's a way to get money for whatever you're looking at, depending on what stage you're at, much easier than what you thought was possible.
I just had a comment on that. I'm actually advising on the acquisition of an apartment complex using crowdfunding. And so to answer your question, you can customize almost every single aspect of the deal. The only thing that's different is that instead of an institutional entity writing one check, you've got a crowd funding the project. So in our case, you could specify, we had to go to a Realty Mogul, right? Because we wanted to go to the national level, which is restricted to accredited investors. That was the only real difference there. But there's this chase for yield because of the low rate environment we've been in. And that's the thing that's driven asset values, especially in real estate, rental properties specifically. And in this market, they're strong. The cap rates are higher than either coast. Take the asset, put it up there, you get to specify your minimum. So you could go down to $5,000 per investor and take $5,000 per from 1,000 people to get to your 500,000. It's the pieces of the deal that a third party needs to do due diligence to say that for every $5,000, this is what you're going to get. And it could be equity or debt. That's the thing that I find particularly interesting is there are some deals that are hybrid also. Traditional investment banking is being taken quite literally direct to
and just to add to that really quick, I think why this is so intriguing to a lot of people is that it's basically for ordinary people to give you money. What's their options, right? Yeah. The yield sucks. Like, look at your savings accounts. Is anybody happy with it? Right? I mean, that's what's fundamentally on the other side of it. That's why people are interested in, oh my God, like I can now invest in something that I previously had no idea I could get into. Especially, this is directly related to the financial crisis. I think my view is that it will be sort of made worsened by the oil and gas situation, what's coming up. Because what happened is that the big banks just get bigger. The top 6 banks today control 67% of the entire assets. They have over $290 trillion of derivatives on their books, right? The small banks, the community banks, they're the ones that are declining. And that's why your savings account is so low, because the big banks literally don't need your money in their bank accounts.
Yeah, it's actually costing them. It's
literally costing banks money to get individual accounts. I'm sure all you guys have, there's probably 6 banks that all you guys have bank accounts in, right? Yeah. That's just the trend. So think about that. Think about that's the supply just think of cash as another supply of a resource. That's what's available right now, and crowdfunding is one way the legal and technology world is sort of coinciding to provide this network that didn't exist before.
So one thing we hear about is that, when you do crowdfunding, especially these things you're talking about, do we have any concerns with the number of investors you're gonna have to deal with? Like if I raised money from a single entity or an institution, I talked to that one person, they gave me some money, fine. But now if I raise it from 100 people, does that change, and what we hear is at least, does that change the way I'm the CEO, I run this company, I've got to spend more time dealing with my investor management as opposed to running my company? Does that change
And that's where
the value of crowdfunding?
I think that's where the legal innovation is coming into place, which is not visible from the outside world. But as you know, every legal document involves so many different complications. So, to example, there are now platforms that structure deals so that even though you're crowdfunding from let's say 100 investors, there's one entity that is pulling that and has a vote for that entire group, and that is the one voice that gets reported on the books of the company on an equity basis. And then to mention Realty Mobile has different models, and so for us, we do revenue sharing loans. It's not equity. You do not give up control of your company, so it's a straight loan. So instead of borrowing $50,000 from a bank for a small business, which banks aren't going to give you anyway because it's not worth their time to underwrite a $50,000 loan, you can get 100 people to give you $500, and it's a straight loan, and we process everything. So to talk about what makes a startup successful and attractive to a lot of investors, as well as what will make you succeed, you gotta make it simple, right? Like just save time from other people and find a way to do that. And I think the reason innovation is important is because generally speaking, technology is the way you make things simple.
What is not to digress on the legal issues, but is kind of what you're mentioning, do you run into, with putting aside the wrapping in an LLC and having one investor, I can't remember the Jobs Act, you still have the 500 shareholder limitation?
There's various different aspects of the law, but the potential of that is pending. There will not be a limit. I mean, so there's different aspects.
So you won't have a registration requirement, they'll have like a reduced
so the Jobs Act
size or?
So the Jobs Act, which is the federal law, the short answer is we don't know because it's so controversial. There's different elements that sort of interest groups, politicians coming in. In Texas, I'll say, the reason why it passed pretty smoothly is, as you guys know, it wasn't legislators debating, it was a regulatory board that just said this is a rule. And that's what made it so much efficient. So if you're a Texas local businesses, it is worth looking into. The only caution that I would say is it's such an early industry. And I think there's 6 portals now approved in Texas, but you have to be careful about what the portals are and what you're working with, because those are the guys that are controlling everything. I mean, for example, the Realty Mobile, those are the guys that basically do the heavy lifting, right? Like they tell you, this is how things are done, this is how you package that investor base. So the portals are what's important.
The platforms are doing a really great job. So the challenging thing of a platform is a lot of these platforms it's the same problem that Airbnb had and the same problem that eBay had. Any two-sided marketplace, in order to have liquidity, needs enough activity on both sides or enough users on both sides for transactions to actually take place. And those transactions, the biggest issues are what the platforms are making easy. We had to consider this also. The more complicated the project it is that you're raising money for, you address the documentation side of it really well. You can use technology to make sure that your communications, your legal is in place. But investor relations is extremely challenging. The simpler the project, the easier investor relations is going to be. And that's why, at the moment at least, the simpler stuff, if I have a portfolio of 10 rental properties in the heart of Houston and this is the yield, as long as they get their check every quarter, there's no investor relations. There isn't, right? But on the other side, you have AngelList, where you could have a team and an idea and nothing. And now you've got the CEO communicating to your entire investor base, just like you would if you had a smaller group, as to what's going on with the company and things like that. The relations are still a challenge, and it's inversely proportional to the complexities of the project.
Good. I'm sorry.
I have a small E&P company, and we were looking at energy funders. They're one of the early entrees into crowdfunding for oil and gas acquisitions. What we do is we acquire kind of what the majors don't want anymore. It's just too expensive for them to handle. So my question to you is what is a typical rate of return the average investor wants to receive? Because that changes the whole landscape of how you're going to approach everything.
I think the answer is it really depends on the deal and the type of investor you are, right? So energy funders and crude funders are another one for you guys, where they're actually a Texas crowdfunding portal as well. So oil and gas projects are listed and you can invest. So I don't know what the investor base is for energy projects. I'm assuming whatever they need is what they need.
Ours is all production. We
Right.
don't drill. All we do is we buy producing wells at a lower
I think to the
discount
point, I mean,
price.
as a general matter, I'll tell you based on our market research, because we're targeting non-accredited base, which is very different than, probably most of you guys, where you're looking for specific asset returns for different, if you're looking at a startup, you're going to want big returns, right? But if we just ask average people, honestly, people, when we tell them, hey, we're targeting from 6 to 18% depending on risk, they love it, right? Like, I mean, not even, and to be very frank, like, if it comes anywhere close to 10% return, like, because for normal people, like, you can't, like, where are you going to get 10% returns? So that's one answer. But then the question, I don't know your name, but the question that you got to ask is like, okay, is a normal person on the street going to invest in your project? Because I have no idea what your project does. So even if you tell me it's a 20% return, like, I don't know if I would do it because I don't know how you're going to get that 20% return. And so that's why we focus on small business lending, because everybody understands small business, right? Like, you literally go to your favorite pizza shop or bagel shop or coffee shop, whatever it is, and if they say, hey, I need to expand my garage and I need $50,000, I'll give you 8% return. People get that. So I think I do think that eventually over time, we will get to a place where people have so much information, so much familiarity with different products, it will become easier. But in the very beginning, crowdfunding, I think, has massive potential. I mean, I did my career on it, but it's going to take time. And it's going to take a lot of education, a lot of focused sort of attention to, on both the investor front and the business front. So if you're interested in that kind of stuff, again, like, you got to talk to different portals because their specialties of their markets.
It seems like on the energy side, there will need to ultimately be a reconciliation of the return profile of producing properties from an equity standpoint with what you can achieve in the public markets with a considerably greater amount of liquidity on your investment.
I mean, our investment,
that's attention.
Yeah, our investment for the investor to make money is the price of oil going up, because we buy $30, $40 a barrel per, for average on the field.
That's good. You just got to explain that.
But you have to explain that on the internet or whatever energy funder was trying to show me what kind of stuff. But it got so complicated. I was like, oh, forget this. So I'm just going to go after accredited investors only, So, but it's been tough. This is a very tough atmosphere to try to raise money for oil and gas, whether it's production or drilling.
A positive I can see, because you're asking a lot of investors, and you probably experienced this. I don't know how many you have here. 15, 20 raising, some of their high net worth, large investments. But one problem with a smaller group of venture capital is they have greater control, right? I mean, the larger the investor, so you go to a fund and you raise $5 million and they own 40% of your company, they have huge control. And they have legal control for the documents, they have control through owning a big part of your business. And whereas you spread it out over a large group, you diffuse that, and obviously you don't have control except on the street. They can vote with their feet and try to sell their stock, but they don't have any control. But I guess, is there a question when you're raising money, and I don't want to get into too deep of the philosophical since we're still on $40 oil, $50 oil, or $60. But it's always struck me as your kind of business, only having invested in it, is extremely high risk, and not so much, and I'm not sure it's financeable from a debt standpoint because there's not many assets, but is there most of the problems in my career, securities problems, have come from people who didn't belong in deals. Like you were saying, the grandmother lost all her money, and then the son calls the State Securities Commission and went down in your offices. And so philosophically, I mean, just anybody in the room, I mean, startups are high-risk businesses, and is the crowdfunding, the transparency of crowdfunding, I think, is great. It's democratized the area, but is it a place for small investors, for startup companies?
I'm going to check out because I had a hard stop at 7:30.
Is it 7:30 already?
It is 7:30 already, but you guys keep going. So I wanted to take 1 minute and say thank you for coming to this event, this open event. We do these 3 times a year, these dinner events, and then we're going to try to do about 6 times a year, 5 or 6 times a year, lunch events. I got a little behind in getting some of those scheduled, so hopefully we'll still be able to have 5 or 6. And I try to moderate those ones, the lunch events, and I certainly encourage any of you to come. I've left my business card here in case anybody wanted to be able to reach out and connect me. But thank you so much for coming in. I'm sorry I had to leave a little late because I had another commitment as well. But thank you.
Continue on with that.
Yeah. Cheers.
So I mean, what do you think? Anybody else?
So I tend to have kind of a conservative approach on this one. I think more financial instruments, offer more options to entrepreneurs like myself. So I enjoy this, but I always tend to think of investments as more than just a number figure. It's the relationship you build with the investor. It's the knowledge, and that relationship you're building with. So I do tend to agree with what I think you were implying, that for early stage companies, for some type of early stage companies, although this would be a nice alternative, maybe it's not the ideal one. We have in our deal, we have a couple of VCs, so bigger investments, but we also have a number of, I call them educated oil and gas investors, and we found that to be a perfect combination. We like the deep pockets of the VCs who can sustain the business in the long term, something that a crowdfunding investor will not do. But if we need some bridge money, if we need a CSB round, those guys can come with a big number of millions. But we also enjoy very much the money from angel investors, who, these are of course smaller numbers, but those guys are personally involved. They have very big reasons to consult with you on a daily basis, give you some directional feedback. So, and one of my recommendations today on this panel is that companies need really to combine the benefits of all different type of investors, and if possible, try to include them all in a deal. I'm not that educated on crowdfunding, so I feel very happy being here and listening to Youngro, but I do identify kind of a weakness for some startups, not having that type of educated investor on their panel. And in addition, of course, all these logistics implications that you talked about, investor relations and all these things.
Matthew, what do you think?
I think early stage companies in tech need a lot of help. And part of what a good venture capital firm or good board members can provide is relevant experience to guide a whole series of decisions and processes that are important at that stage of development. My issue with crowdfunding is, as a pathway, you need to find a substitute for that competency and experience being available to you. And if you can bridge that, great model. Fees can be expensive. But you fundamentally, in early stage technology, in the early stage anything, you need a lot of help, and you're generally better off if you have good people around you.
I agree with that. I thought the crowdfunding, or I've advocated, similar in Asia, the micro lending initiatives that gave. So every tech company, early stage, needs at least $50,000 to do nothing more than protect their patents, do a business validation. I'm not talking about legal.
This is a plug for our host.
Yeah, just there you go.
I agree with all of
The most important, and I don't do patent work, but the most important thing, bar none, because I've seen so many deals screwed up by the patents not being protected. They're going out raising money and they're talking about their customers. Next thing you know, so I agree with that. The micro lending, crowdfunding kind of fits a micro, small amount of money, $50,000, and maybe for fixed income instruments also, like real estate or apartment houses. But the flip side, to be a devil's advocate, is what it doesn't give you is what you were just saying. I'm interested in what your thoughts, and you already kind of echoed it, is VCs are connected, and they also have deep pockets. They can make follow-on investments, but they also have input to exits. And then angels invariably are somebody in the area, hopefully, like Kemal in your case. So, what do you think of that value? That seems like you don't get that crowdfunding, but I guess you can go back to the well and add those pieces afterwards.
So I think one thing, well, the short answer is it depends on I think, who you are. I think just because somebody doesn't have absolute amount of money doesn't mean that they're not sophisticated or they don't have the intelligence to review it. And just because somebody has a lot of money doesn't mean that they are sophisticated, even though the law treats them that way. And so when I talk to investors, because I mean I was in the private equity fundraising business as well, you know, in my legal career. When people just ask me, can I invest in that? I just tell them, hey, if you don't understand it, don't invest. Now, that's the bottom line, no matter how much money you have or how much money you're considering to move. So having said that, I mean, I agree with you that there is a lot of, that's for me a downside and a potential sort of risk factor of crowdfunding, because a lot of companies are pitching it as like, hey, like invest in my great idea, and somebody who hasn't had experience of it might be like, oh, that sounds really cool. Let me put $5,000 on it, you know? So you got to be careful. So from an investor perspective, just because it's possible doesn't mean, you know, you should do it. And I think from a more of an angel, because you talk about angel VC background, I will also say a lot of the great companies, and so this is my personal experiences because I have sort of friends in the startup industry. A lot of the great companies today, they're already funded. The good companies aren't going to come up with crowdfunding. Not a lot of them for equity investments, because the good companies, they're stacked up. There's so much. I mean, we have a lot of money on the common investor side. On the VC angel side, there's also so much money. They're just looking for the deal to invest in. So anything decent, like Houston Angel Network, I think, was literally the most active angel group in the country. So be careful when you see an equity. But at the same time, if you're interested in it, pay attention to it. Because this is literally day one of what is going to be for the rest of our lives. So I would pay attention to it, be careful. But if you think you understand the risks, and you think you understand let's say in a startup context, not the idea, but the team behind it, they're good enough, they can execute, because really, no matter what people say, it's the team that matters, the execution that matters. The idea doesn't mean anything, because anything can change. If you believe in that, then yeah, I mean, I think it's a great opportunity, and personally, I don't think the government should be telling people what you can and cannot do. So.
I want to add something to that real quick. I think there's a strong distinction here. There's money and there's smart money, right? That's the bottom line, is one of the things, right? If you need smart money, don't go and crowdfund and pander to the average investor. If you know that you need, because in any early stage startup, especially in a very specific niche, knows that who you're raising from is perhaps more important than whether you're raising at all. You might be better off not taking those funds. So I think it's important for the person raising the money to, but here's the other thing. Even if you want smart money, and maybe you're in Houston, you're not in Austin, maybe you're not in San Francisco, how do you reach smart money? That's where platforms like AngelList come in, is that AngelList now has something called syndicates, where the average investor can follow a lead investor in a round.
Accredited investors.
Right? Sure. But unsophisticated, even though the law thinks they are, is the point I was trying to get at. And then on the other side, you have, if you're simply trying to raise and the project is simpler, then you can communicate a lot of the things that businesses are finding resistant to raising capital. What's happening with Realty Mogul, for example, repeat entrepreneurs. Entrepreneurs are now building a reputation for bringing solid projects to crowdfunding. Once you've developed a reputation, that becomes your currency. And you can go back to the average investor who at first didn't know who you are, and maybe you had to raise at not so ideal terms just to get your name out there and build a reputation as an entrepreneur who delivers.
Kind of like an eBay rating.
Yeah, exactly. And I think crowdfunding eventually goes the way of the equity markets, where the average investor is able to purchase, shares in publicly traded companies. And you've got penny stocks taking grandma's money even today. And I think crowdfunding, the same thing happens. The credibility of the individual or entity raising the money matters.
I mean, and that's why, to be frank, real estate is probably a leader in crowdfunding, because, everybody understands it somewhat, right? Like, I mean, there's a building there.
You have a tangible asset.
Right, there's a building there. I think that's why it's been successful. And when you're trying to sell equity in some amazingly sounding technology, like, what does that mean? And I think that's also the trouble in the oil industry. Like, for those of you in this room, you might understand it, but for somebody who's on the street, like, they're not going to know even like how, I don't even know how the drilling takes place, right? So That's
I'll
such
teach
a, I'd love to learn, I'd love to learn. But, and then the other point on the branding perspective, if you got, for the entrepreneurs out there, so for example, our platform supports small businesses, because again, similar to real estate, we think that's something easier for people to understand. So we're talking with a coffee shop owner who he's like small business entrepreneur, but he's been very successful. He has different ideas. He wants to open a bar, he wants to open a restaurant. And I believe him, I think he's gonna do amazing. But what I tell him is, hey, like, people don't know you yet, especially if you're gonna try to access the crowd and not just your 3 business partners who always been asking 50% equity for every new project. If that's the case, don't go for something new. Like, just open a second coffee shop, which you know is doing well, which is generating over $1 million in revenue. Let people invest in you and pay them back. When you pay them back, you make some money, next project comes up, it will be subscribed, first day, right? Because people have that track record. So that's part of your strategy. Just know, crowdfunding, you just have to understand one way, it's just an easier way to access different people. That doesn't mean you're gonna get the money or the money that you want, but it's just a different way to reach people, and what you do is up to you. And that's, I think, a very important point.
In general, I think more choices is always a better thing for entrepreneurs. And now we're talking about crowdfunding. There are other types of funding. A friend of mine raised funds through pseudo-currencies, bitcoins. There are all kinds of different platforms, and we may like them, we may dislike them, but they do exist. And those are good choices for entrepreneurs. We talked today about VC funding, we talked about angel funding, crowdfunding, but there are other ways too. I mean, there's state funding, there are federal grants. So if you have a startup, it's, as a CEO, it's your obligation really to exhaust all different types of financial instruments and really pursue them all not in a sequential manner, but in a parallel way.
Matthew, what's the most creative startup funding you've seen?
In the .com era,
Good segue.
Wait, what?
in the .com era, which is not what we're in now, it was ridiculous. So creative really meant a investor group broadly that was concerned about missing out. And the euphoria combined with the perception of missing out just started to drive sky-high valuations to the point at which it bordered, and to this day in all the history books remains ridiculous. Illustration. A company that our corporate development and private equity group invested in was getting ready to complete an investment, which we did. $1 million of revenue projected. Was bought for $1.3 billion by Arena.
Wow.
Jeez.
That was, those are the Goldman Sachs days.
And I remember getting the phone call, the evening before the transaction was going to be announced, asking whether we were still committed to our relationship with them and if we would be, interested in investing. And my only question was whether it was X, Y, or Z firms, and as long as it wasn't them, we could stay in the deal. And I was praying that it was not, and it was not. We made a lot of money, but you look back at those days and it was just stupid. Yeah. It's literally all it was. There's no other characterization of just irrationality and exuberance combined. So stupidest way, silliest, that's the stupidest pejorative term.
Most creative.
Most creative is when valuations tend to be so outsized that from an issuer perspective, it's easy. It's just easy.
Right.
Most creative in a different context, I would suggest to you, is what we're in now, where you are having to justify every single aspect of every dollar that you're looking to raise and go through a clinical exercise to rationalize that there's a return available associated with it. $50 crude oil does that to a lot of what would otherwise have been sensible projects. Because the math doesn't work at $50 oil for a lot of things that are discretionary.
Right.
So, you know, I admire the CEOs and entrepreneurs and CFOs that work through and really get back to articulating that the core idea is one that is sustainable through cycles, because this has prompted people to realize this is a cyclical sector, and there's, you know, ups and downs, but the core idea is good, it's a sustainable business, and making money. Those are the creative transactions.
That's good. Why don't we do this? Why don't we, we're the last few minutes, take questions or general thoughts, the rest of the group?
Quick question. On the crowdfunding side, I have a startup which is a combination of product and consulting for a non-oil area. Any comments on that? Any difference in terms of crowdfunding, or I mean, in terms of recommendations?
Sorry, I'm not sure if I understand the question.
So I have something which, so I have a service for community banks, for example, which is a combination of a product and some consulting services wrapped around it. From a crowdfunding, does that crowdfunding go on the technology side? Would it be more preferable to go for a product or on the consulting, or does that really matter? Is it more about the idea?
You mean to raise money for your business to expand or something like that?
Yes.
And are you trying to sell equity or debt? Or?
Yeah.
So I think from a debt perspective, again, when we talk to our investor members, I mean, we've had hundreds of sign-ups since we launched last month, they want returns, right? And the issue is like, well, can you explain that? So I don't know, it depends on your business model. I'd be happy to talk to you separately, but if investors don't understand, they're not going to. You know? So for us, I mean, we have a deal right now. It's a hair salon. I mean, it's simple, right? Like, it's a hair salon. So I think it just depends on what's your business, what's your revenue history, and are you going to get people money back? I think if you answer those questions, I'm sure a lot of people would want to invest, but if not, probably not.
Okay, other?
So after we've been talking about this for, this hour and so, it seems like, when we came up with this topic, I thought I was going to hear a lot of, well, it's awful, we can't raise money, but it seems, everyone seems pretty, from an entrepreneur perspective, pretty positive. Is that money is available and that you can still get money? Did I misread all the comments, or is that it?
I'll volunteer to answer that. I'll volunteer to answer. I think there's lots of money available, but I think Mathew said the best is it's going to be more selective. That there was a euphoria, just shale gas exploration. I mean, we were seeing a deal every 2 weeks on shale gas technology that was coming in. Everything on this, a lot of geoscience, things that we didn't really understand. The money was, everybody was kind of, it wasn't as bad as the .com, but everybody said shale was the future, and a lot of money was chasing, particularly in the angel area, what I'd say, is foreign investors, wealthy investors. So I think you were saying it's going to be more selective in particular technologies in the energy. There's lots of money. I did some research, so I called one of our venture capital clients today, and he said there is billions, tens of billions. The whole United States venture capital market raised maybe $40 billion last year. But worldwide, there's tens of billions of dollars available. But they're,
I think you've got to separate, I think that's an important point. You've got to separate the amount of capital that was raised and sits uninvested in funds that needs to get invested before it has to be handed back, with the selectiveness of the investment ideas and theses being pursued in this price environment. There's a litany of deals that would otherwise have passed the litmus test of a number of energy-focused private equity or venture-type funds that won't get invested in today, period.
But and I know you guys have some comments, but I am curious. So one thing that Youngro said was, look, if I go to my bank today, I get 1% return, or less than 1%. So if I try to allocate my money to a fund and say, okay, you go invest for me, I expect to get, back maybe 5 years ago, I expect to get a 20% return.
Yep.
But maybe I'd be really happy with 6 today, because I'm only getting 1 at the bank. So wouldn't that reset some of the expectations of these funds that are, instead of.
I want to hear what it says.
Well, I'm just curious, like, what
Chasing
you
yield
said.
is a different deal. There's lots of people chasing yield. You can achieve yield in all manner of forms. You can achieve yield in energy, investing in very reputable, asset-rich, high-yield bonds of credible companies that are going to pass the test of time. You can achieve that in public markets today, okay? But the early stage, I'm chasing an equity return, you just have to be mindful is competing against the idea of uncertain timing on when product will be viable or service will be viable, combined with how do I see a path to an exit? And that's the tension, I think, that you're going to have to reconcile. But absolutely, am I happy to get 6% from investing in the only hair salon that's sitting right here when it needs 10? That's a good idea.
I think
Assuming they had a good stock.
Check it out. www.nextseed.com. But just to answer your question, I don't know if there's less money today. I think the point that I'm trying to make, that we're trying to make, is there's more opportunity. Period. And it's cheaper to do something now than it ever was before. I think that's what I tell other folks who want to experiment, and you got to prepare for it, especially like people, depending on what your personal situations are, because obviously not everybody can just go out and do something. But for me, for example, like I knew that I wanted to do something, and I saw this opportunity, and I literally, to me, I had a number in mind. I want to save X dollars so that I can do my own thing for the next 2 years and not have to worry about putting food on the table. And I let that go, and I quit my job and I started it. Right? I mean, I'm not saying that works for everyone, but it's an opportunity for especially those of you guys with perhaps not happy doing what you've been doing for a long time. Right? Especially, like, I think we've kind of avoided the subject, but when we're talking about prices of oil going down, we're basically talking about loss of jobs, right? Loss of career options. So if we're basically saying that's going to happen in the next 6 months or a year, shouldn't we be preparing for that individually, right? For our families individually. So if that's the goal, like look into the opportunity, look into what the options are. And crowdfunding was just one way to do it, but there's so many different ways to go about it.
I just like to add, like when we talk about the money that was on the sidelines, it did not get invested. A lot of that is because these were the smart investors who did not chase yields and were disciplined about their investing. So as an entrepreneur, if you are able to get in touch with those investors, they will be willing to stick around with you over the bad stretch and be with you for the long term.
That's a good comment. Okay, well, I guess thanks a lot. Thank you all.
Folks, one of our charter members joining from California. I'd like to thank Chuck. Panos, I know you drove from Austin.
Yes,
Spencer to see us. Thank you. Mathew, very articulate, very thought-provoking. And Young, man, I'm excited. I'm going to go look up your Thank you, Ali, and Osha Liang for not only sponsoring the event, as well as allowing us to use the facility. And Najib Baki and his team for coordinating all the logistics would not have been possible without your help. Once again, we appreciate it, and looking forward to seeing you at the next Open Houston event. You can go to openhouston.org and see some of the really amazing events we do around entrepreneurship, around professional career development, around emerging leaders, and then our annual conference in August of this year. So once again, thanks.